So today we are discussing about the cost of capital. It is topic three. The topic three of the financial management in terms of the computations is not as per the syllabus as how you can see it. Again, also you need to be factoring much about the theory part of the financial management. It's very crucial. Now, when we are looking at it, we just need to be rushing a bit. I can just do 2 classes in a week and I complete the financial management. It is not hard for me. But the level of cooperation is very important. I know very well, kama ningeanza the classes at 8. Now we could be somewhere tackling the WSCC computations and so on. So that one, please, let us engage. Now, the cost of capital, it is based on the minimum required rate of returns by the providers of the long-term funds. When you look on the organizations which you normally go and work for, I know now you are having an employment somewhere whereby you have to be doing a work and so on and so forth. And there are books which you normally maintain. For example, someone might be maintaining the assets register. There are those who are doing the credit control areas. There are those who are doing the payables, receivables, and so on and so forth. We have also the other guys who are going to be checking on the aspects of the capital structure of the organization during the budget processing, the budget making process. Because the budget making process is whereby we are going to be looking on the areas in which an organization can be able to generate funds, right? And the funds we can be able to get based on the standard, the financing standards, we can be able to get all this information from, we can be able to get funds from 3 aspects. One, the equity, which we talk about the cost of equity. We talk about the cost of the preference share capital, and also we talk about the long-term debt and debentures, right? When you go to the advanced level, you are going to be borrowing this cost of capital, which is basically incorporated under a topic which is basically called the advanced financial decisions. The advanced financial decisions basically incorporates the aspects of how the organizations are going to be funding their projects. And basically, we have to be looking on the existing capital structure of those organizations. Now, in that topic is where we are going to be talking things called levered and unlevered firms, right? The levered, you know that it is a company which is basically financed by equity. We have unlevered, which basically factor the aspect of equity and debt. So those are the things, sorry, it is the vice versa, unlevered and levered, sorry. The unlevered equity, the levered both. Now, when you look on the factors that influence the firm's cost of capital, number one, we basically talk about the component costs. And these are the cost of specific sources of finance to the company. And that is the thing that I've already discussed. Now, in taking you easily under the aspects of the computations of the cost of capital, it is very important for you to understand that the component cost, whether you are doing the WSCC or WMCC, you have to be computing the component costs. That is, you have to be determining what is the cost of equity, the cost of preference share capital, and the cost of the long-term debts. So the other component cost, we are saying it is better to the organization. Eric, you are joining with 2 devices, I don't know. Now, when you look on the weights are basically the proportions of each capital component in the firm's capital structure. And the component with the highest proportion affect the firm's cost of capital more than the other components. Now, let us look on the tax rates. Now, the companies that operate in an environment of higher taxes and to use more of debt finance in the capital structure, this is because the interest on debt, by the way, you know very well, when you are doing these things with the Edwin Ochoy regarding the income, preparation of the income statements, there is an area I normally see you discussing about the interest on loan, and therefore that aspect of the interest on loan basically reduces it normally reduces the net profits, therefore reduces the tax payable. Now, the availability of assets to pledge as a security. A company that has collaterals may easily use debt finance to finance its operations. The quotation at the stock market, a company that is listed, that is, whose securities are trading at the security market, can easily raise additional funds through the issue of ordinary shares to the public, unlike a company that is listed. So the firm's cost of capital is a combined cost of the three. The cost of equity, the cost of the preference shares, and then we have the cost of the long-term debt, right? Now, let us talk about the cost of equity. It is the minimum required rate of return by the providers or by the ordinary shareholders. And in this case, we are saying it is the discount factor that is going to be equating the present value, the dividends, to the current market price per share. Now, when we are looking about the aspects of the valuation models and so on, that what I can be able to attest is that we have not talked about the valuation of the ordinary shares. And that one I will be able to come up with a video during the week, and then I will be able to share with you. Now, when you look on the aspects of the, based on the aspects of the cost of equity, we are saying that when we are purchasing some securities, for example, I know very well that there are these people, I know Eric or anyone else or the Judy, we have already invested in some circles, and you normally buy securities, you normally buy shares and so on. And then there is a time which normally comes and you want to dispose them. You cannot be able to dispose at a price, at a par value. A par value is the original price of the security. But you normally look on the market prices of those securities. So in that case, you basically have to be, when you're doing your computations, whether you want to determine the value of a firm when you are going to the advanced level, the value of the firm, you normally have to be checking on the market price per shares. You multiply by the number of the ordinary shares. So we have to be looking at how much is the value of our organization now. It's not at the period in which the securities were trading, unless the aspects of the shares have not appreciated for quite some time. They have not, they are yet to appreciate, and they are still trading at the original price of the securities, as you can be able to see in most of these cases. Now, two methods are available for computing or calculating the cost of equity. Number one, that is why I want the students to be following up on they have to be following up on the topics the way I've been sharing them. So when you look on these two methods, for example, the Godon's dividend growth model, the Godot dividend growth model is one of the model which is basically used to value the ordinary shares, and we are valuing them under the three types of the firms. I will be able to share a very interesting topic there regarding to that. Then we have the capital asset pricing model. So when you go to the advanced level, we are going to be criticizing the CAPM, right? I can see here we have our CAPM. We are going to be criticizing it. It's not APM. When we are typing, we forgot to put C there. So it should be CAPM, CAPM. Now, when, for example, you can be able to look at these, I would like to illustrate these on my board. Let me illustrate it here. I don't know whether I have my board, but it should be somewhere. Can you be able to see the boards? Let me know, please. Can you be able to see the boards?
No.
Okay, right now. Right now, yes.
Yes.
Okay, very simple here. I just want to do some illustrations. I just want us to do some illustrations regarding to these formulas and how we are supposed to be doing the computations. And I will be moving very fast. And I will be incorporating I want to incorporate some questions which have already been tested so that we can be a bit able to, we can be able to understand component costs, right? We have started with the cost of equity. The cost of equity is denoted by KE, okay? So we have said we can be able to value this by using what? By using the Godon's dividend growth model, the Godon's dividend growth model. And we have said number two, we can be able to use CAPM. We can be able to use the capital asset pricing model. Now, when we want to evaluate it using the Godot dividend growth model, when we want to evaluate it using the Godot, we are going to be recalling how do we normally get the market? It is basically when you are looking at the valuation model, this PO, it is normally called the intrinsic value. We normally get it by taking D1 divided by KE minus G. D1 minus KE minus G. And from this formula, we want to make the KE the subject. So in this case, you can make KE the subject. Can you be able to make the KE the subject? And in this case, you can just be able to cross multiply. We say, if we take D1, it should be equal to PO, right? We take KE minus G, then you divide here by PO, and you divide here by PO. All of that goes. So in this case, we say D1 over PO should be equal to KE minus what? Minus G. Take the G on the other side, and we are going to be having KE, which is equal to D1 over PO plus what? Plus G. Someone might be asking, what are these? I will be able to define what all this means. Someone is greeting me. Let's see. Okay, Nina's left. Now, when you look at it, when you look on the aspect of the shares are basically issued to the market. They are normally issued to the market to gain the attention of the subscribers or the people who are interested. And therefore, we normally talk about in case the shares are issued, at a discount, or flotation, they are issued at a discount. It means it normally affects the market prices. So in this case, when the shares, and in our questions, we can be able to see our shares are basically issued at a discount. We say the KE, our formula now changes to D1 divided by PO minus discount plus the growth rate, Now the formula changes. The discount now reduces the market prices. It normally reduces the market prices, right? And also we talk about the things of flotations. In case the shares are issued with a flotation, or in case the shares incurs flotation costs, in case they incur flotation costs during the issuing time or during the issuing process, right? We say the flotation cost affects the market prices. They normally affect the market prices, and therefore the formula now for KE will always be D1 over PO minus discount minus flotation plus our growth rate. This is now how the formula basically looks like. This is how our formula looks like, right? Now, when you look on the equity, and when you are going to be learning about equity, I'm just following my notes. I think you have these notes. Now, when we look on the equity is normally categorized into two. Equity is basically categorized into two. We normally have the ordinary share capital, right? And then we normally have the retained earnings. Where are we getting the challenge now? Where are we getting the challenge? Let me see. What might be the challenge? 1 minute. 1 minute. I just want to know why it is hanging. The internet is very strong. Okay. So the equity comprises of the ordinary share capital and the retained earnings, right? And when you are going to be doing the things regarding to the, when you are going to be doing now, the issue regarding to the WCC, because we are going to be giving out the difference between the weighted marginal cost of capital and the weighted average cost of capital, right? This one we normally look on the existing capital structure of the organization. The capital structure of the organization. This one, right, we normally want to look at the additional funds. Additional funds. We normally want to look at the additional funds when we are dealing with the WMCC, but we don't want to change the capital structure of the organization through the WMCC. We are looking for the additional funds, whether we want to do the research and development cost, whether we want to do the new products and so on. So that is why the WMCC, basically, it is looking for the additional funds, whether you want to carry out the new projects and so on. So when you're going to be looking on these two, the equity, the aspects of the ordinary share capital and the retained earnings, you know that the ordinary share capital is normally issued to the public, issued to the public, is normally issued to the public for subscription. It is normally, but the retained earnings, it is never issued. The retained earnings is never issued. So when you are calculating the formulas for the two, right? When you are doing the formulas for the two, just 1 minute. I don't know what is the problem. Minutes means my heart might not be clear. Just 1 minute, 1 minute. Kidogo tu. So where were we? I was discussing a very simple concept here. During the computation of the two, so when you are calculating the cost of equity, when you are looking for the cost of equity of the ordinary share capital, we normally take what? We normally take D1 over PO minus D minus F plus G, right? But when you're calculating the cost of equity for the retained earnings, we normally take D1 over PO minus discount plus growth rate. It means that the retained earnings are not affected by what? They are not affected by the flotation, since they are not issued to the public for subscription. That is why we don't deduct what? We don't deduct flotations here. Now, you remember very well, when you are doing the valuation models, D1 is equal to DO 1 plus G, right? So the formulas of yours is not a must that every time you are given D1. Then it means that you can be able to replace the numerator with this. DO 1 plus G. You can be able to replace that when the current dividends are just being paid. Now, what does this all means? When you look on our notes here, right, I have been able to explain part of them, part of the notes. So when you look on the part of this, you'll be able to realize that the KE is the cost of equity. We have D1, which is the expected dividends, which is also talked about the next year's dividends. We have our DO, which is our current dividends, When you look at the dividends for the year just ended, it is the same thing, which basically means, the same. We have our D, which is our discount of the issue of the ordinary shares. We also have our F, which is our flotation, stroke the issue of the cost of the ordinary shares. We have our G, which is our growth rate, right? All of that basically discusses about what is the meaning of our formulas. Now, down here, we are discussing about different methods basically used in the computation of the growth rate, because in most instances, the examiners will not be able to give you the growth rates. Now, let us look on how we can be able to compute these growth rates. How can we be able to compute these growth rates? Let me see here. Now, we can be able to compute our growth rate through things. I think I should be changing my camera now from tomorrow. Now, when you look at the aspects of the growth rates, right? We normally have different methods basically used in the computation of the growth rates, right? Let me look at them before we go now to the questions and we see how can we be able to apply these formulas when they are coming in the question. Basically, the examiner, when he brings all these, he wants you to calculate the WSCC or WMCC, right? So when you see those questions, then you have to be knowing very well that examiner wants me to compute the following. Now, the growth rates, we say the growth rate is basically determined using the following formulas. We normally have the following formulas here to determine your growth rates. So formula number one, once we want to get the growth rate, we normally take the root of, and outside your roots here, we are going to be having n minus 1. We take the most current dividends. We divide by the most past dividends. All of these, we subtract 1. That is one formula. That is one of the formulas, right? One formula. Now, from there, we can also be able, when you look on these, there's a number of periods. Number of periods. So it might be 8 years, 4 years. It depends on the setup of the question. Number two, we normally talk about, to get our growth rate, we normally take our B times RE. What is our B? Our B is the retention ratio. What is a retention ratio, right? A retention ratio is a proportion which is basically left within the organization, whether for investment purposes, right? And we normally get it by taking 1 minus payout ratio. Payout ratio, this is a proportion which now you are going to be giving to the ordinary shareholders. Well, and they normally determine, they normally agree whether it is 40, whether it is 50. they normally agree what will be their payout from the net profits. How much are they going to be getting for themselves, right? And this is only applicable when the organization is making profits. Now, when we talk about RE, we talk about the return on equity. So the return on equity, we can be able to take it to take the profit after tax. We divide by equity if it is not provided in the question. We divide by the equity. If the examiner has not provided it, then that is how we can be able to get it. And the return on equity, in most cases, can be IRR, internal rate of return. The internal rate of return can be also the return on equity, can be also the return on equity. When you look on the questions, I will just do some random questions and apply the knowledge which I have already just elaborated here, a bit of it, so that when we are meeting, by the way, we are going to be meeting on Sunday. For those who are not here, you just need to alert them. On Sunday, we have to be meeting, so that I just want to finish up with your classes. Now, when you look on Sunday, when you look on this question, I just want to look at some few which are using our knowledge for better understanding. So let me start with this one. Where are my questions now? Okay, they might be here. My loft, where is my loft now? My loft, let me see. You see my loft? This is how you open it. I don't know whether it's the one that you basically use when you normally use your lofts. So let us see. Will mine open? Okay. Then we are looking for the CPA questions. Then you search here. Financial management. So let us look at a question here. Let me look at May 2018 here. There is like a simple question which is here. Very simple, very easy. Now, in our question here, there is a question which they tested for WCC, and this is how it reads. You can see, and these questions they normally promise a lot of marks. So in this question, we are being told, Akiba Limited has the following capital structure. They have already given you the capital structure there, right? They are going to be providing those capital structures. So they have provided you with what? So we are being told there is 3 million fully paid ordinary shares. We have the retained earnings, 1 million 10% preference shares, 6% debentures, so 150 per value. Then the additional information, number one, I just want to factor the aspect of the ordinary shares. Number one, we have been told the current market price per share is 30 shillings, right? The expected dividend per share in the following year is 1.20. They have given you the expected dividend, right? Now, the average growth rate in both earnings and dividends has been maintained at 10% over the last years. And we have been told the trend is expected to remain the same into the foreseeable future. Right. Number 4, number 5 to 7, we are not factoring them. I just want to show you when you are dealing with the cost of equity, what am I supposed to be doing? What am I supposed to be doing? Now, how you are dealing with the cost of equity. Remember, the question of viewers now is on May 2018, question number 3B, right? And then you want to analyze the cost of equity, KE. Don't forget the formula. You say, to get the cost of equity, I normally take D1 over PO plus G. Plus G, right? And we have to be looking at, are we provided with the requirements to calculate the cost of equity? Say, our D1, right? We go back to the question and we see, do we have our D1 here? We say yes. The current market price we are being given, the PO now, the PO is 30 shillings. The PO is 30 shillings. Now, note number 2, we are being told the expected dividends, that is the D1 now, which is different from DO. So So the D1 is how much? We have been told it is 1.20. Then what about the growth rate? We say our growth rate in number 3, we have been told it is maintained at 10% for the last 10 years. So how are we going to be getting the cost of equity? We say, to get your cost of equity now, I take, for example, we take 1.20. We divide it by 30 plus 0.1 plus 0.1 plus 0.1. So how much is this? How much is your cost of equity? How much is the cost of equity? So I just need to take 1.2. 1.2 divided by 30, then plus 0.1. You get 0.14. We get 0.14. 0.14 or 14%. 14% or 14%. That is how you get the cost of equity. That is how you get the cost of equity. Let me look on another one. November 2017. Question number 3 what? Question number 3B. November 2017, question 3B. Let me see. You can see how you normally analyze the cost of equity. That is what I want to do. The cost of equity first. So let's see the next one. The next one will be, we have said November 2017. So how is it November 2017 here? Yeah. We go back to the question. Do you have November 2017? You just search, yeah? November 2017 is there. And then it is very important, by the way, you know the code of the paper which you are doing. So you are doing November 2017. There is like a question here. Question number B. So we have been told Ray Properties is planning to build a business more. And we have been told the project will cost 180 million. So the firm's current optimal capital structure, you can see here, now we want to raise new funds, but I will be able to give you a leeway for this. Now here we are being told the firm's current optimal capital structure is as follows. Ordinary shares 10 per 480 million. 10% debt. This is the ordinary shares, the equity and debt. But not number 1 you're being told. I just want to look on the areas of the equity. In note number 2, the new ordinary shares will be issued at a current market price of 30 each with a flotation cost of 5 per share. The more recent dividend paid by the company was 5 per share. The dividend is expected to grow at a rate of 5% per annum in perpetuity. And then the firm is expected to retain 18 million. That one we shall be able to discuss as we progresses. But because I want to give you a good background, let me show you how you deal with note number 2, number 3, and number 4. Number 2, 3, and 4. Now, this is how you deal with it. This is how you deal with it. This is how you deal with it. Now, when you look on that note, you come here and you say, to get my cost of equity, I take D1 over PO. And for example, now, we are calculating two cost of equity, right? Because we have to be looking at the cheaper between the ordinary share capital and the retained earnings. And I remember I was able to explain this to you. So when you are calculating the cost of equity of the ordinary share capital, we said this D1 over PO minus D minus F plus G. And when you are calculating the cost of equity of the retained earnings, you remember when you are calculating the WMCC, you have to be looking on the cheaper source, which you can be able to get the maximum. So in this case, when you are going to the WMCC, there is something that we normally call the breakpoint to utilize a source fully. Now, in this case, we are talking about D1 over what? PO minus D plus G. Now you go back to the question. You go back to the question now. You go back to the question. You're being told in note number 2, the new shares are issued at a current market price of. Now we are being told our PO. Our PO is how much? Our PO is 30 with a flotation of 5. 30, flotation is 5, right? 30, the flotation is 5. The more recent dividends are paid by the company. Now in this case, it means the formula now changes. It will be DO 1 plus G. You divide it by PO minus D minus F plus G, right? Because they have given you the DO. The most recent, the dividends which have just been paid, DO, So we have been told they are paying at how much? Those dividends are being paid at 5. Then our growth rate, we have been told it is 5%. So let us calculate the cost of equity of the ordinary share capital. So when you take the DO of yours, it will be 5. 1 plus 0.05. You divide all of these by the market value, which is 30, minus the flotation. The discount is not there. So the discount, when it is not there, don't force it to be. Now, plus our growth rate of 0.05. So how much is this? How much is this? How much is this? Now, in this case, we say it is 1.05. 1.05 is this one. You multiply by 5 now. You divide it by 24. Then plus 0.05, getting around 26%. 26%. When you look on the cost of equity of the retained earnings, the cost of equity of the retained earnings. Now, the retained earnings are not affected by the flotation cost. And that is what you can be able to see here. So in this case, we talk about taking 5, 1 plus 0.05, you divide by 30 plus 0.05. How much it is? 1.05, you multiply by 5, divide by 30 plus 0.05. We are getting 22.5. 22.5%. 22.5%. So when you're going to be doing your analysis now, you want to do your analysis regarding on which is cheaper source between the ordinary share capital and the retained earnings. You see, this is 26. The cost of equity is 26%. This is 22.5. So it means you need to utilize the retained earnings fully. You need to retain the to maximize. Then during the break point, we are going to be saying how do we normally maximize that to the maximum? How do you normally maximize it fully? Now, we also have another concept which you are able to learn here with you, which I just want us to teach how it goes. Under May 2017, this one should be the last one now, so that we progresses. We can progress. Where is May 2017? Let me look for it. So we have May 2017. May 2017 is here. So in May 2017 here, we are talking about, let's see, is it question 1C? Correct. So Upendo Limited existing capital structure is given as follows. The ordinary share capital of 20 million, the reserves of 5 million, and also we are being given the 10% debentures and the 8% preferential capitals. Now, we have been told the additional information, and we are focusing on the ordinary shares. They can see that the more recent earnings per share, they have given you the EPS of the company is 5. The other thing they have told us is that the funds adopt a 40% payout ratio as dividend policy. The other thing they are saying is that the ordinary shares of the company are currently selling at 50 shillings. Now, those are the only things given there. Okay. So it means through that information, the examiner wants us to calculate one thing, the growth rates. Now, they have told me a lot of issues there. They have given me a lot of issues, but I've been told that the existing debenture, blah, blah, all that we don't need. So let us factor this. One, based on the information provided here, we have to be choosing which formula to use. So which formula are we using here? We normally use the formulas for the growth rate based on what is given by the examiner. What is given by the examiner? This is what you do now. You say, to compute your growth rate, right, we are going to be taking, for example, in this case, we are going to be using B times RE. B times RE. Because already they have told me, we say to get our B, we normally take 1 minus payout ratio. And when I look at when I look at what? When I look in note number 2, the firms adopt 40%. So this will be 1 minus 0.4, getting 0.6. Then we have the return of equity. Return on equity. So the return on equity, we are going to be getting it by taking the PAT over equity. The PAT, the profit after tax, you divide by the equity. Now, we say, to get the profit after tax, which is not given in the question, we are going to be taking the earning per share, we multiply by the number of ordinary shares. And when I was looking on that question, we don't have the number of ordinary shares. Do we have the number of ordinary shares? We say no. So how are we going to be taking the number of ordinary shares? Now, Rudy pale kwa capital structure. I say, let me take 20 million now, which is the total value of the ordinary shares. We divide by the par value of 20, getting around 1 million. 1 million ordinary shares. 1 million ordinary shares. So to get the profit after tax, we are going to be taking what? The earning per share. How much is the earning per share? It is 5. 5, we multiply by 1 million, getting 5 million. Getting 5 million. What about the equity now? How are we going to be getting the equity from the question which you have already been given? The equity now comprises the ordinary share capital from the capital structure plus the reserves. So it will be 20 million plus 5 million, getting what? 25 million. Therefore, the return on equity, we are going to be taking what? 5 million divided by 25. 25 million. And therefore, we are getting 0.2. So it means that to get our growth rates, we are going to be taking 0.6 times 0.2, getting 12%. 12%, getting 12%. So it means, if I want to calculate the cost of equity now, D1 over PO plus G. So how much is my D1? How much is my D1? As per note number 3, we are being told the ordinary shares of the company are currently selling at 50. That is what we're being told. Stima nikawa imerudi huko akina Nina. Now, we are being told that the 50 is our PO. Sorry. So our PO is equals to 50. Our PO Nina is 50. Tumesonga kidogo. So it means this DO, 1 plus G, you divide by PO plus D. Because you have to be looking at what is the requirement in terms of the D1 and DO. It depends on how the examiner is giving it. Now, the current, because we have been told that the dividends which have just been shared right now is how much? Have they stated? Are they stating it? Okay. Using the Gordon's dividend growth model, can you be able to determine the cost of the ordinary share capital, the cost of the preference, or that? Yeah, we are being told up there. The most current, the most recent earnings. You look at something there. 1.12. Okay. So how am I going to be getting the very simple? So it means the examiner has not given you the DPS. The dividend per share is not provided. So how am I going to be getting the DPS? Very simple. The earning per share we multiply by the payout ratio. The DPS is not provided by the examiner. If they don't provide, no problem with it. So I can be able to take the earning per share. As per the question, the earning per share will be given as 5. Then the payout is 40%. This one is 2. That one is 2. That one is 2. So when you are applying the formula of DO now, which is the DO 1 plus G, you divide it by PO plus G here. It means your DO will be 2. 1 plus 0.12, which is our growth rate, which we are able to compute here. You divide it by what? What is our PO now? What is our PO? We say our PO is how much? Our PO is 50. Plus 0.12. Plus 0.12. Very good. Very good. So it will be 1.12. We multiply by 2, divide by 50, plus 0.012. Getting 16.48%. 16.48%. That is the simplest way. That is the simplest way of calculating it. You can just apply the same concepts and you do this. You do November 2016. How can I do it for you? Let me do it for you. Let me do it for you. You will not get it. Let me do it for you. Let me do it for you. You'll be able to do yours there later on. So let me do November 2016. It is just that I just want you to have a very good background on this. So November 2016, some of you says that in ya kitambo sana. No. Do you know that the CASNEP does not have time to set new questions? They can pick a question of 2010. Bring it now. Very good. Very good. The question is question number 2B. I don't know whether I have shared my screen. Okay, yes, it is already shared. Nina, can you read? Nina, can you read? Judy, can you read? Mna login na mnalala, ama mna login, yes, mna login na mnalala. Show me we are together, eh? Okay. So Sunny Limited presented the following extracts of the statement for the financial position as at 3rd October 2016. They have given you the equity, the long-term liabilities. So the additional information they have told you, note number 1, the ordinary shares of Sunny Limited have a next dividend market value of 47. Okay. The market price is, or the market price per share should be X dividends. So in most cases, when you see CAM dividends, the CAM dividend market value, it means that those dividends, the CAM dividends mean these are the dividends which already includes the dividends which have already been declared. The dividends which have already been declared. So therefore, it means that you have to be deducted. So for example, if this 47 was the CAM dividend, I could have deducted, for example, 3.63. Now, per share, the ordinary share dividends of 3.63 per share have just been paid. So the following dividends have been paid over the last 4 years, and they have told us that the years have already been provided there, 2013 to 2016, with the respective dividends there. Then we have the DPS for each year given. Now, in this case, when the examiner gives you an information, for example, as you can see in additional number 2, it means they have not given you the growth rate. So which formula can I be able to use there for the growth rate? And you come in your, you just run here. You say, so you run here and you say, to get my growth rate, nikiangalia swali yangu the way it is being set, I normally take the root of n minus 1 there. We say the most current dividends. We divide it by most past. and all of these we subtract 1. So when I look on my project here, the number of years is 4. The number of years is 4. Are we together? The number of years is 4. So in this case, it will be 4 minus 1. The root of the most current dividends. The most current dividend you can be able to see, note number 1. 3.63. You divided by the most past ni ile ya kwanza. The first one. The first dividend which was declared by the company. Those are the 3.09. Right? 3.09. All of these, we subtract 1. All of that, we subtract 1. So in this case, you come in, you tell me, let us take 3.63 divided by 3.09. Remember this one is 3. 4 minus 1 is 3, right? So you have already gotten your answer. So in this case, you come and you say now, in your keyboard, you say 3. You press your 3 from the keyboard. Then we have shift. You press shift, and this has something looking like this. This button looking like that. Shift this button. So shift that button, and we are going to be having 3 x and root now. And we put the answer which you are able to divide these two. Okay. So my answer, I'm going to be getting my answer, which you are going to be getting here, something like 1.055. Then we subtract 1, getting 5.5%. 5.5%. This is what you need to do a lot of practice. So this one you divide by this one. Then you come back here. 3 shift. This one you get this. Then you put your answer. This is what you are going to be getting. I know that up to that point we are together. So the growth rate of yours is 5.5. Then you go back to the formula. You say the KE, we are going to be taking the O, 1 plus G, you divide it by PO plus the growth rate. What is our DO? We say our DO in note number 1, they have told us it is 3.63. 1 plus 0.055. You divide it by, what is your PO now? The market in note number 1. The X dividend market value is 47 plus 0.055. How much is the cost of equity? How much is the cost of equity? How much is the cost of equity? So 1.055, we multiply by 3.63, divide by 47, plus 0.055, getting 13.65%. 13.65%. 13.65%. That is how you do all these concepts. Before you read the cost of equity, an examiner can give you uncertainty, can give you some problems there, which you need to solve, The next component cost, you know very well, it is the cost of the preference shares. The cost of the preference shares. The cost of preference shares, it is our next component cost. Okay. So how much it is? 1 minute. I'm just looking at the cost of the preference. Just want to pass on the notes. So we are being told here, the cost of the preference shares. Now, these are the people who have already been investing in circles like you and me, right? You don't own the ordinary shares, but what do you normally own? You own the preference shares. Now, those are, for example, who are buying their shares from the CMA and so on and so forth. In the Nairobi Stock Exchange and so on. So these shares, are being traded at specific market prices. Now, when you look at this, we have been told the reason as to why you normally invest in shares, you want to get some minimum rate of return, right? You just want to get the minimum required rate of return from those investments. And that is why we are saying the discount factor that is going to be equating the present value of the expected private dividends of the current market price per share. So how do we normally get those market values? We normally take the preferred dividends, we divide by the costs. That is what we can be able to recall when we are doing the valuation models. So the market value is equal to the preferred dividends, we divide by the cost of the preferred shares. But when you make the subject, the KP the subject, we are going to be getting it by taking the preferred dividends, we divide by the market values. In case of discounts or flotations, stroke the issue costs, it basically reduces the market values, and therefore the preference dividends will be equal to the cost of the preference shares will be equal to the preference dividend divided by the market value minus discount minus flotation cost, whereby the KP, the cost of the preference shares, and V is the market value per share, which basically it is normally called the intrinsic value. D is our discount on the issue of the preference shares, and F is our flotation cost. Now, NB, they are down. We have been told in case the shares are issued at par, that it means that they don't have any changes. They don't have any change in terms of they don't have any change. Therefore, it means they don't have any flotation costs. Then the KP become the coupon rates, stroke the preferred dividend rates. So it means that the shares are still trading at the original prices. They are still trading at the original prices. Now, we cannot even do the illustrations as how we were doing there earlier before, because the time is running. What I will be able to anticipate now is we keep time. On Sunday, we can meet at 4 p.m. please.